Okay, so hello and welcome everyone. This is lecture 9 in my series of microeconomics lectures. For some classes, this material might actually come relatively early. It might actually be week 1 material in some classes. My philosophy is let's kind of mention this a little bit during week 1, which is what I did, and then let's do this a little bit more carefully now in the middle of the class when we get closer to where we're actually ready to talk about consumer theory. And that way you don't forget stuff in the intervening time. So, all right. So here we're talking about decision making by individuals and firms. And basically the concepts here we expect to be able to apply either to individuals or to firms. Okay, so the first slide, talking about people responding to incentives, and I'm illustrating this with an example from the John Ball Zoo. So take a look. This is regular pricing during the couple seasons when it's open. So we have spring, we have summer, and then we have fall. What I want to call your attention to is the summertime, right? Summer pricing. My example, or the example, deals with summer. So adult price was $10, seniors $9, children age 2 to 12, $8, and then children under 2 is free. So here's the example. On Friday, August 7th, 2015, Grand Rapids, Michigan, the zoo had a kids day, and so they offered reduced admission, $2 admission for kids day, and 12,000 people came to the zoo. Right? So what's going on here? Well, people are responding to this substantial decrease in price. Right? So for an adult, $8, and then maybe you come with a couple kids, and so you're saving $6 per kid, right? So what ended up happening? We get 12,000 people lining up for an hour, right? So lines over an hour. If you look at this link here, you can actually search and see the press on it. You see a really long line, and they interview some people, and so. We can think about a number of interesting things here. First, this illustrates the principle that people respond to incentives, this price difference. Another thing is people incur a substantial cost waiting in line, right? Think about the true cost to go to the zoo that day. It was not $2, right? $2 is how much the admission was in terms of cash outlay, but people paid with their time as well, right? So suppose you were working a job where you could have earned $10, $12 during that hour had you not been waiting in line. Then what you've done by virtue of spending that hour waiting to get into the zoo is you've given up the opportunity to earn $10 or $12. That would be the opportunity cost of your time. Anyway, so the point is, in order to make good decisions, we want to first clarify relevant costs and benefits. One place to start is by assessing opportunity costs, which is what I just said. Now, opportunity cost, this is the cost of what, the true cost of something is what you must sacrifice. It's what you have to give up to get it, right? So the true cost of anything is what you must give up to get it. That is our definition of opportunity costs. Why do we care about opportunity costs? Because of scarcity, right? So back to scarcity, because we can't use the same resource towards two purposes simultaneously. We have to make choices. We face trade-offs, and those trade-offs have costs. You can use your hour to wait in line to get into the zoo, or you can use your hour to work or sleep or whatever else, but you can't use that same hour to do both. So, all right. Now, going a little bit further, we can define implicit costs and explicit costs. And basically what we want to do is we want to think about how opportunity costs compare to other monetary outlays and so on. So by explicit cost, we mean some cost that requires transfer of money. We're thinking of a cash outlay. So the explicit cost in the Kids Day example was $2 admission per person. The implicit costs, these do not require the outlay of money. These are typically what come to mind when people think of opportunity costs, though opportunity costs are more broad. But implicit costs are like the value of your time. If you're studying, the implicit cost of spending that time studying involves the value of your time, which you could have spent doing something else, perhaps working. So maybe we can put a monetary value on the value of the time that you give up when you study versus something else. But there's other implicit costs that are not necessarily related to time or to money. So things like your attention span. You have a limited amount of attention span before you need to take a break and do something else. And you can only devote yourself so much to academic activities during a given day. So fortunately, that bar's pretty high. So you should be able to study several hours a day. And indeed, that's good advice if you want to reach your goals. So anyway, we use these two ideas of costs, explicit and implicit costs, to define economic profit and accounting profit. And this helps us figure out, do benefits truly exceed costs? So, all right. Kind of a mistake that people make before studying economics and sometimes after is ignoring implicit costs and focusing only on cash outlays. So you might have people in the interview from that line at Kids Day saying, "Hey, the cost to go to the zoo that day is $2." No, that's the price of admission. The cost to go to the zoo that day includes the value of your time spent in line, the fact that it's crowded. For some people that might be a benefit, for other people maybe they don't like crowds, it's not so good. Anyway, the true cost has to involve opportunity costs, right? The opportunity cost of any activity, we're going to define this as being equal to its explicit cost plus its implicit cost, right? So with opportunity costs, I said was more broad than just implicit costs. Well, that's because with opportunity costs, you can think of the opportunity cost of your time as well as the opportunity cost of your money, right? So obviously, when you're waiting in line and not doing anything super productive, you lose that hour. And so people waiting in line lost an hour of value, and that's the opportunity cost of their time. But there's also an opportunity cost of those $2, right? When you spend $2 to get into the park, to the zoo, or anything else, you are giving up the ability to use those $2 for anything else that you might think of. Okay, so here's an example. What's the opportunity cost of going to graduate school once you finish your undergrad degree? Well, it involves the explicit cost of tuition and fees, right? So that's an obvious cash outlay. It also involves the implicit cost of the foregone salary you could earn during that time, right? So if by the time you're going to grad school, you've completed an undergrad degree, presumably you can earn a pretty decent salary, and so you've got to count that into what you're giving up when you go to grad school instead, right? So even if you have an assistantship, even if you have a grad assistantship where the school's paying part of your tuition, or if you have subsidizing with a stipend or something, that's still going to be less than you could get if you were working a full-time job with a bachelor's degree, right? So you have to think about what is the cost of attendance, and this includes explicit costs, what you're actually paying in terms of money, and what you're paying in terms of your time and attention span, focus, those sorts of things. Okay. So we'll think about the relevance of opportunity cost to thinking about profit. So how do you figure out if something's profitable or optimal? So here I'm talking about profits. Typically we're thinking about profits from the standpoint of firm. But like I said, this lecture deals with decision making of individuals as well. So it's a little bit awkward to talk about, is it profitable to go study this weekend for an individual? But you can think of profits in some senses pertaining to individuals as well. Later we'll develop the idea of utility. So and a lot of these ideas transfer, at least in the background, to those discussions. All right, so by accounting profit, we simply mean revenue minus explicit costs. So this is just a straightforward, somewhat naive calculation. Just find revenue, subtract explicit cost, and there's your accounting profits. When we're doing economic profit, we're going to have to calculate this by subtracting off the opportunity cost of resources used. So this is going to give us a lower number. Typically, accounting profits are going to be higher than economic profit. Why? Because usually opportunity costs are not zero. If opportunity costs were zero, then accounting profit and economic profit would agree. But you have to pay attention to opportunity costs. So when the firm uses their space to produce something or to engage in some business activity, when they're calculating whether or not their endeavor is profitable, you have to think about, could I have rented that space out at a higher rate to some other firm, right? Or could I rent out my factory or equipment or so on and so forth? So there's an opportunity cost. When you use your factors of production for your particular firm, you give up the ability to allow somebody else to use them, right? So that's why I say economic profit is equal to revenue minus the opportunity cost of resources used. So resources would be the things used in production. All right. So the big difference from our standpoint now is economic profit includes implicit cost. Accounting profit does not. And when we get to perfect competition, we're going to say one of the outcomes of our assumptions of the perfect competition, perfectly competitive market is that there is zero economic profits in the long run. And this always drives students a little berserk the first time you hear this, because you're like, oh, why would we expect firms to stay in the market if profits are zero? Well, there's two things there. First, there's not a whole lot of markets that actually matches perfect competition entirely. That doesn't mean the model's useless. The model's an important starting point, and it helps us getting a sense of sort of a little barometer on a particular market. Also, it helps us getting used to thinking about the role of assumptions. But nevertheless, there's not a lot of markets where there's zero profits, zero economic profits. But the important thing, though, is, why does that assumption make sense in the context of perfect competition when we get there later in the course? Well, the perfectly competitive market outcome is zero economic profit in the long run. And so you got a dog barking. And so not my dog. So zero economic profit in the long run assumes that opportunity costs have been taken into consideration. So that's where when a firm is earning zero economic profit, we're assuming they are covering their opportunity costs, and so they're breaking even. Okay. All right. So thinking about my brother's decision to found his own law firm rather than work for somebody else, well, at a certain point, maybe you've got an internship, you've been working for a while, or whatever, you decide to strike it out off on your own as an entrepreneur. And as you're thinking about, is this going to be a profitable venture? You want to think about the opportunity cost of the things that are going into this business, the printer, the office space, so on and so forth. That's obvious. You also want to pay attention to the opportunity cost of your time. So think about what salary could you have earned working from someone else. So typically when people start a business, the first couple of years, they might not have positive profits, right? And so there the calculation might look a little different than in the long run. But what you want to do is to calculate, is this endeavor profitable? You want to compare what's the foregone value of salary, for instance, and resources. So what's the lesson? Well, when computing the profits of their enterprise, the entrepreneur needs to deduct the value of the salary they could earn working for someone else. Another example, when I was in college, I had some friends who started a running shoe store. So think about, is this thing profitable? I mean, that's a really difficult market to enter, and they had positive revenue over costs, but what's the value of the entrepreneur's time? Well, at least for the first couple of years, they could have earned a higher salary elsewhere, and then ultimately the business became a little bit more profitable. I haven't checked for a while. I think they're still in business. But what's the point? Well, you want to think about, what are all the relevant opportunity costs for this entrepreneurial activity? All right, here's an aside helping us think about the opportunity cost of resources used in production. So capital, by this we mean the total value of assets owned by the individual or firm. So physical assets plus financial assets. For the firm, it's obvious. We've talked about that already. So it could be, the capital used in production. It's your factory space. It's your business space. Any machines, printers, whatever, computers. And so why is that relevant? Well, those things could be sold, or could be rented out to other firms, and so they could be a source of revenue. Instead, when you use them for your own business activities, you incur the opportunity cost of having not used them for something else. This is also relevant in terms of individual financial assets, right? So think about, suppose you save $20,000 for down payment on a house and you go ahead and make that purchase. Well, you want to think about the opportunity cost of those $20,000, right? So the financial assets carry an opportunity cost, because rather than putting a down payment on a house, you could have invested in your retirement or something like that. And then you want to kind of track the rate of return you would have earned for those for the $20,000, both in the value of the home equity or value of your house versus what it could have done had you had invested. So anyway, the implicit cost of capital is the opportunity cost of the use of one's capital. the income earned if the capital had been employed in its next best alternative use. That's exactly to give some formalization or make more formal or more rigorous what I had said previously with the example of the business that could use its printer for its own purposes, or it could sell it. Or you could use your office space for your own business, or you could rent it out to another one, right? Same thing for an individual, use $20,000 to buy a house or a car or retirement or whatever. So we have alternative uses, and we have to pay attention to these when we're judging whether the decision is sound. Okay, and that's exactly what I'm saying in this last part here. Okay, so now we want to talk about either or decisions and how much decisions. So either or decisions are where you're just comparing the cost and benefit. So this would be like, are you going to go home for the weekend and study, or are you going to go home for the weekend, or are you going to study for the weekend? Presumably not at home. Are you going to buy a car or not buy a car? So in those decisions, those are either or. You do one thing or you don't. We've got two states of the world, mutually exclusive. And so what do we end up doing? Well, let's compare the costs and benefits and do the one where there's positive economic profit. How much decision? This requires determining where to stop, right? So how many hours to study? How many miles before an oil change for the car, right? So do you study for 12 hours? Well, I mean, after the first 2 or 3 hours, maybe there's some diminishing returns where the value, the benefit you're getting might be small relative to the cost. Who knows? Kind of depends on, I mean, probably you want to take a break and then go back to studying is what I'd recommend. But, you know, sometimes you want to devote the whole weekend to studying. And usually the advice for students is not to study less, it's to study more. Most students I've talked to, when I ask how much you're studying, very often from my sort of biased sample, the survey I've gotten is most people, most students will talk as though they believe they're studying quite a bit. But they're actually probably doing far less than would be optimal. So anyway, according to the principle of either-or decision-making, when faced with an either-or choice between two activities, just choose the one with the positive economic profit, right? So this is just a cost-benefit analysis, whereas the benefit bigger than the opportunity cost. All right. How much decision? Now we want to compare marginal benefits to marginal costs. So the marginal benefit is sort of the incremental change to your well-being, so by virtue of doing one more unit of the activity. So the marginal benefit of sleeping for another 15 minutes would be the value that you get from laying in bed versus getting up. Then there's a marginal cost. So this is like the incremental change to your costs, the total cost, right? So the marginal cost of sleeping for another 15 minutes is the foregone value of that time getting ready or getting to school or work earlier or whatever. So basically, when we're thinking about marginal benefit and marginal cost, we're thinking about small incremental changes. So blocks of 15 minutes or 1 minute, right? Or think about the value of studying for another hour, the value of running for another mile, value of running for another 10 minutes, whatever it is. All right, so production. Here I'm talking about production. Yeah, you can talk about production in terms of the firm. That's what I mean this as, but this applies to individuals as well. You know, you could think of something that you do that might have increasing marginal cost, like the production of studying, right? So the number of hours that you're clocking away and logging in terms of studying, there might be an increasing marginal cost. So the 6th hour in your weekend of studying might be more costly to you than the first hour, right? Production has a decreasing marginal cost when each additional unit costs less to produce than the previous one. The quintessential example here is the airlines, or aircraft. So the first aircraft off the assembly line, costs tremendously more than the 100th. And the idea is that, costs fall because of when you produce a larger volume, the average costs fall. But another thing that happens specific to marginal cost is that the workers learn how to make that particular aircraft pretty efficiently. And so the marginal cost of producing one more aircraft, going from the first aircraft to the second, the cost might be pretty similar. But going from the 99th to the 100th, maybe the cost is relatively low because you've got a little bit better. So anyway, production has a constant marginal cost when each additional unit costs the same to produce as the previous. And then the marginal cost curve, well, we're going to build the marginal cost curve later in the course. But for now, we can just say, hey, the supply curve is a marginal cost curve for the entire industry, right? We said the height of the supply curve gives us marginal cost. That's exactly it. So as you might imagine, we're going to do the same thing with the demand curve. So the height of the demand curve gave us the marginal benefit. It gave us the willingness to pay to the marginal consumer. So we can display the marginal benefit curve with the market demand curve, right? That's the marginal benefit to consumers. We can talk about decreasing marginal benefit. So this is where for the particular activity you're engaging in, each additional unit of the activity gives you less benefit than the previous one. So my example would be eating In-N-Out burgers, right? So In-N-Out burgers, probably my favorite burger. So you go to In-N-Out, you can get a double burger. The benefit from eating the first one is far greater than the benefit from eating the fifth, right? If you make it five burgers in, you're getting to your decreasing marginal benefits are definitely have definitely set in, where your enjoyment from the fourth and fifth is less than going from the first to the second. Same thing with drinking water if you're thirsty, right? So drink half a glass. The first half a glass, the benefit to drinking the first half of the glass is larger than the second half of the glass, or whatever, if there's several glasses. Don't want to drink too much water. So, okay. So some rules with small quantities. The rule for choosing the optimal quantity is this: increase the quantity as long as the marginal benefit is greater than the marginal cost, and then stop before the marginal benefit becomes less than the marginal cost. So do you eat that fifth double burger? Well, only if the benefit exceeds the cost of doing so, and that cost is the relevant cost is the price, but then the opportunity cost of the relevant opportunity cost. So anyway, the optimal quantity is a quantity at which the marginal benefit equals the marginal cost, and I'll show this in a little bit with a couple statements. According to the principle of profit maximization, the principle of marginal analysis, when making a profit maximizing how much decision, the optimal quantity is the largest quantity at which the marginal benefit is greater or equal to the marginal cost. Okay. All right. So here's basically what we need to worry about. So if the marginal benefit is bigger than the marginal cost, do more of that activity. If the marginal benefit of studying another hour exceeds the marginal cost of spending that hour studying, you should study more. If the marginal benefit of studying for another hour is less than the marginal cost of using that hour for studying, you should study less. That's probably not the case for most people. You can think about this in terms of sleeping. If the marginal benefit of getting another hour of sleep exceeds the marginal cost, yeah, you should sleep more. If the marginal benefit is less than the marginal cost, you should sleep less, get up earlier. And then where do you want to maintain your current level? Well, if marginal benefit equals marginal cost. So think about for a firm, if the marginal benefit, the marginal revenue of producing one more unit of output exactly matches the cost of producing that unit of output, that's where the firm should maintain its production plan. We want to produce, we want to act, we are optimizing where marginal benefit equals marginal cost. Okay, and then when making decisions, knowing what to ignore can be just as important as knowing what to include in the decision. So we want to ignore sunk costs. Sunk costs are gone. You can't do anything about them. You should ignore sunk costs, and that's because it doesn't have any influence on the incremental marginal benefit or marginal cost. So let me give you a vivid example to illustrate. When I was an undergrad, I was trying to decide what I wanted to major and minor in. So I went to the bookstore and I paged through some of the books that I would be taking in the prospective majors and minors. And in the economics book, I remember this example. It talked about going to an all-you-can-eat spaghetti dinner where you had to pay $15 for your plate. So you pay the $15, you go in, and you try the spaghetti, and it's awful. It's really bad. So what do? From an economic perspective, what you ought to do is you should just leave. Just leave at that point. You cannot make your life better off by continuing to eat that really bad spaghetti. Some people might think, oh, I'll stay there and I'll try to eat my money's worth. No, you can't do that. If you try to eat more of this bad spaghetti, you're actually making yourself worse off, right? Because the spaghetti's terrible, the marginal cost of eating it is less than the marginal benefit, so you shouldn't eat any spaghetti. How do you think of the $15 you spent on that plate? It's gone. That's how you think about it. It's completely gone. There's nothing you can do. Nothing you can do to get the $15 back. And the only action you can do is leave, and then at least you maintain whatever is your current loss $15, or you could stay there and you could keep eating, and then you're gonna leave further behind because you're gonna be $15 out and you're gonna have eaten a lot of terrible spaghetti. So okay, a couple concepts. A rational decision maker chooses the available option they most prefer. Right? So basically, people are selfish and rational is a standard assumption in economics. Basic idea is the rational decision maker is going to see from an array of opportunities, they're going to pick the one that they most prefer. We'd say it's irrational to choose something that would give you a less benefit when a clearly better option is on the table. Right? So the irrational decision maker chooses an option that leaves them worse off than choosing another available option. Wow, so I realize this slide totally needs to be revised, but I'm not going to redo the video. So, all right. Decision maker operating with bounded rationality makes the choice that's close, but not exactly the one that yields the best possible outcomes. So, bounded rationality goes back to Herbert Simon from Carnegie Mellon University. So you could think about basically the assumption I just gave you. Economics assumes people are selfish and rational, and if you take that assumption to heart, it's pretty strong. The reality is, people are quite limited, and that's kind of what bounded rationality does. Bounded rationality approach realizes that people are constrained. There's human limitations in terms of intelligence, calculating power, attention span, time, these sorts of things. And the basic idea is that we're not expecting that people are going to optimize all things considered, but people are going to choose something that's close, at least close to optimal, given what they're able to do. Risk aversion is the willingness to sacrifice some economic payoff to avoid a potential loss. So, if people are interested in avoiding risk, they might end up giving up the opportunity to have higher gains. So basically, here we're thinking about expected values. So expected value, we're talking about like the probability of some outcome times the payoff from that outcome plus the probability of not that outcome, the complementary probability in a binary choice situation times that value. And then if that is higher than some flat non-lottery choice, the person who is risk averse is going to choose the sure thing. They're going to avoid the lottery because they don't want to tolerate the risk that they could get the worse option. So anyway, so risk aversion, it's important to mention from my class, what I've just said now about risk aversion is the extent of what we need to worry about for introductory micro. Later on, if you continue on in the economics major, then we can do all kinds of cool stuff with risk aversion. Okay, so some mistakes people make in economic decision making: misperceiving opportunity cost or failing to account for them entirely. Being overconfident, maybe in your abilities, or a variety of other things. Having unrealistic expectations about future behavior. So maybe you don't study this weekend, get an exam coming up in 2 weeks, you don't study this weekend because you believe you're going to study next weekend. And then next weekend comes around and you find out that there's something else you'd want to do. And you decide to procrastinate and maybe make some bad choices and end up not studying. What's the better choice? Well, spread your studying for exams out over each weekend of the semester. But that's hard to commit to. That's hard for people to be able to do. Counting dollars unequally. So this is if you're thinking of, this would be like, you get a birthday card and it's got some money or some other holiday or whatever. Somebody gives you some money and they say spend it on something. Spend it on something fun. Don't spend it on bills. Well, I mean, what's the difference, right? So suppose you have $20. What's the difference if you spend those $20 at Starbucks versus, $20 towards your rent, right? Essentially, the money all goes in the same place and goes out the same place. But sometimes people will earmark dollars kind of in their minds, which is interesting. It's an interesting thing to study. Being loss averse, so trying to maybe along with loss aversion is the result from Kahneman and Tversky, demonstrating that people value losses much different than equivalently sized experiences framed as a foregone gain. So framing matters. If we think about something as a loss versus a foregone gain, though they're sort of equivalent, there's different behavior we might see. And then having a bias towards the status quo. So this would be like failing to re-optimize, failing to change your plan. So just maintaining whatever you've always done and not considering changing your ways can be sometimes suboptimal. At other times, just maintaining the status quo can be time saving and can actually be a result that we might expect from bounded rationality, where, do you search for the optimal paper towel roll? Well, no, you probably just buy whatever's cheapest or buy the same kind every week or whatever. Okay, very good.